Boom, we're live. Hi, everyone. We're back with Blockchain Center. And the topic for our discussion today is digital assets and high net worth individuals and family offices. And we are joined by amazing speakers, Jackson Zeng, and Brown, Trent Barnes from Zerocap, and Peter Borovykh from Ronin AI. Hey, guys.
Hi, greetings from Melbourne.
We have two people from Australia here today, and Peter is in New York. To kick it off, I would like to ask you to tell us a couple of words about yourself and how you are involved in this space, starting with you, Jackson.
Yeah, thanks. So my name is Jackson Zeng. I'm from Caleb and Brown. We started our OTC desk in 2016 in Melbourne, Australia. So we're one of the oldest players in the Melbourne space. We kind of watched this space develop and grow from when we were beginning. There were no AML policies. So at the beginning, we were saying the regulators need to catch up. The regulators have done a good amount of progress now, and there's policies in place for everything. But as a service, we focus on high net worths at the beginning. And what we were trying to do was get larger transactions into deeper liquidity, which was usually available internationally at the time. But now our service is more focused around getting a broad range of assets, making sure our investors can get access to anything that they want at the best liquidity, and making sure that we have broad coverage and we can facilitate the transactions in whatever method that our clients are looking for.
Thank you, Jackson. Peter?
Hi, guys. So I'm the co-founder of Ronin AI project. So very similar. We deal mostly with high net worth individuals, not because we necessarily want to, but because these are the only people who can afford our offering. And we see lots of problems with even with high net worth individuals. You would think that they have everything figured out, they earned some money, maybe inherited some money, and it's all good. But in reality, they are aggressively seeking for alternative investments. They're looking for artificial intelligence solutions. They're looking for cryptocurrencies and alternative assets. And unfortunately, the level of their financial sophistication is extremely low. So it would be nice to explore this topic today on this webinar.
Thank you. And Trent, you are largely an inspiration behind today's panel. Can you tell us a couple of words about what you're doing at Zerocap?
Yeah, definitely. But firstly, thanks for having us, and good to be on the panel with everyone else. Coming from Melbourne, which was once the world's most livable city, but now we've been locked down for a few months. So essentially, one of the principals at Zerocap and head up client relations. Essentially, we are a digital asset trading, insured custody, and we provide yield products to high net worth individuals, family offices, and emergent wealth globally. So essentially, our mantra is zero friction, borderless finance. And we want to be able to bring the same services that you would experience in a private bank, and so a fully managed bespoke service, including education, optimal pricing, privacy, secure custody, and post-trade settlement. But yeah, I think, looking forward to today's chat and sort of jumping into digital assets and I guess where high net worth individuals sit within that.
Thank you. And my first question would be around the topic of our today's discussion. So when we're talking about digital assets and family offices and high net worth individuals, what is it exactly that we're talking about? Because I think for largely wider audience, it's mostly either OTC desks or Bitcoin whales come to mind, or maybe custody solutions, because mostly these are the people who will need these solutions. So what are we talking about here? What should we focus on when we're looking at this space? Maybe would you like to start again, Trent?
Yeah, I guess it'd probably be worthwhile breaking down some definitions. So if you look at, for instance, the institutional investor, they would be sort of your banks, endowment funds, hedge funds. And you could probably even slide family offices into that, although we tend to put them in their own category just for our own purposes, just to separate them. High net worth individuals typically would be around, 1 million plus. And depending on how you would classify that, we like to classify that in terms of liquid financial assets. And particularly if, moving into where we're located, both Jackson and I in Melbourne, in Asia Pacific, what we noticed is a lot of the trends coming out of Asia, and I think being in the Asian century and the third decade of it, we're probably going to see more billionaires come out of China and India than the rest of the world combined. So I think it's going to be a really interesting geographical location for the emergence of high net worth individuals. And I'd also classify in terms of one of the demographics that we look at as well as emergent wealth, which is typically millennials and Gen Z, range in age from 20 to 40 years old. So this is a demographic that we think is perfectly suited to the digital asset space, and because they tend to veer away from traditional investment theses. So that's how I would probably classify the different high net wealth, institutional, family offices. Be interested in the other guys, just what their thoughts are on that.
Got it. And Peter, I think the angle of your work enables you to take a slightly different perspective compared to what both Trent and Jackson are doing. So what's your definition of what we are talking about today? What should we focus on?
Well, first of all, I fully agree with Trent regarding what we see. Same types of demographics. So in the US, the perfect portrait of a person who would be looking for some kind of alternative investment is 40 to 50 to 60 years old, high net worth individual, which is $1 million net worth. Whether this is liquid $1 million or not, that's a different question, but overall, that's $1 million. When it comes down to emerging countries, though, the portrait is slightly different. It is guys in their 30s looking to make a difference. Typically, that wealth is being inherited, and they just want to prove something to their parents regarding the fact that they can actually manage those funds. I mean, I'm just being 100% realistic and transparent regarding what we are seeing. Now, is that a good trend? That's a different situation. That's a different question. But that's what we see now. We also have family offices and institutional investors representing crypto hedge funds reach out to us in the attempt to get AI analytics or use or integrate our AI somehow to their trading models. And what we see is that the level of the education of those institutional investors relative to what we would typically see on Wall Street is, 1 out of 10, 10 being the best and 1 being like absolute nothing, maybe 1.5. Absolute misunderstanding of what risk is, absolute misunderstanding of the crypto asset class, absolute misunderstanding of the ecosystem, who controls what. I'm not even talking about the technology. Technology is like nobody gets it. So everybody wants to store their funds with some custody or on blockchain.com without trying to do their own node by simply syncing Bitcoin. So that's the focus should, in my opinion, be on high net worth individuals and retail investors for whom the crypto assets have been built in the first place, and then massive education.
Yeah, I think education is very important. And I think compared to what we saw in a couple of years ago, even judging by the public space and what we see in the media, it seems that family offices and high net worth individuals and institutional investors in general, they kind of start to warm up towards digital assets in general, trusting more, or at least showing more interest in what it is and how it can help them make more money. And my next question is for Jackson. Why do you think this is happening? And first of all, is this accurate? Because sometimes we can rely on reports, but in case when we're working with such a closed up group, we can only rely on someone's opinion who actually works with this type of clients.
Yeah, sure. Thanks for the question. I'll actually speak on only my side of things. So I can definitely agree with Trent on the definition. But from our client base, we're seeing much more 40 to 60-year-olds that seek our service. And that perhaps has something to do with our service offering, which is that every customer has a personal broker that they pick up the phone and engage with that runs them through the education process. We're generally finding that the younger audience, they're more interested in delving into the space on their own. They figure things out on their own. They look at tutorials on their own. Whereas the more sophisticated investors or more experienced investors who are generally older, they'll usually have the foresight to ask a professional and have them walk them through the process. In terms of are they coming out and seeking alternative investments, I think the process for the traditional space is that usually products get approved and then financial advisors will bring these up with their high net worth clients. And that's generally the kind of the customer journey on how these assets get adopted. For crypto, because it's in a space where financial advisors can't touch, all of our clients are coming to us first. They will have their financial advisors. They're not doing anything for them. These customers are all coming to us on their own. They're saying, I've learned something, maybe online, maybe from a friend. People are talking about it. I'm getting no official advice from it because they're not licensed to do so. So I'm going to come to you myself and figure out this space and have you guys run me through the process. So yes, that's definitely happening. Who's leading the charge? The investors themselves are leading the charge. I don't think any of the financial advisors are doing any work, making any contributions there.
It's very interesting when we were discussing the preparation for this panel with Trent. Trent, I think you mentioned an ad for Bitcoin. Basically, now it's time to buy Bitcoin in one big financial magazine. I don't remember what it was now, but I think it was by Galaxy Digital or some similar player. So yeah, it really seems that partially this wave of adoption is driven by players who want to target this group specifically. So yeah, like, what's your opinion on that trend?
Yeah, definitely. Yeah, you're definitely seeing a lot more media, particularly within on traditional media platforms coming out, particularly because of, I guess, the economic uncertainty at the moment. When you really look at the communication to the general populace, and talking about what Jackson just mentioned in terms of clients that are coming to them directly and coming to companies like ours directly because their financial advisors aren't able to provide that level of education and consultation. And so they're seeing a lot more media around it. I've definitely seen a lot more personalities pop up trying to get back into, because DeFi is definitely showing up on a lot of people's radars because of guess what's been happening. And since the big drop in March, Bitcoin as well as a whole bunch of other digital assets are getting a lot more media attention. And so I think in terms of there's a lot more curiosity, because I think that's definitely one of the attributes that contributes to I guess a successful client relationship for companies like ours, which is having that curiosity first that can be satiated by a high level of detail and knowledge, and ensuring that they're comfortable. So I think you're going to see a lot more media coming out in regards to primarily around Bitcoin is what I've seen, and because it really has been establishing itself as a safe haven asset, an inflation hedge. I think you have a lot of, particularly our clients that are worried about the excessive money printing and quantitative easing. If you really look at, even just some of the other popular media out there, which was MicroStrategy a couple of months ago, where they took 250 million of their cash position and bought 21,000 Bitcoin or something like that. And that was based on a belief and the dependability of Bitcoin store of value and had a better long-term appreciation than cash. which was absolutely brilliant PR on their side. And I think their stock price even jumped up in double figures at that time. Back in May, there was media coming out, particularly among the traditional finance world, with Paul Tudor Jones, billionaire macro trader, hedge fund manager, and came out and said he had close to 2% of his assets in Bitcoin, and that it was a great speculation and that it was severely underpriced. So I think we're going to start seeing more of that. And I mean, there's always been a lot of talk about the institutions are coming. And, I think the institutional protections are now, and they're in place. And you've got big custodians like Fidelity that entered the space a while ago. You've just got a lot of great security, insurance, custodian solutions out there. And so, yeah, I think just to wrap that answer up, a lot more media coming out. It's touching the public consciousness, in a pretty meaningful way now. And I think because of the current COVID conditions or the economic conditions in climate, definitely look into another asset class to which, Bitcoin and other digital assets, I definitely think are compelling choices for it.
Thank you. And you just touched upon a very interesting topic that's trending right now. It's DeFi, decentralized finance, and multiple tokens that are traded on Uniswap, for example. And my next question is, so is there preference for some specific assets? So, okay, Bitcoin was around for longer. That's why this group of clients trusted more. Or maybe because like DeFi, maybe until recently, because now the market also dropped. Was it the preferences for someone with very cutting edge thinking? I know that Peter is involved on the trading side. So maybe Peter, would you like to take this one?
I'll even, answer from a more tech perspective, because we're working on a bunch of blockchain projects. So far, our team has been working on probably 5 to 10% of, well, maybe it's too loud to say, but 5 to 10% of the public projects that you guys see in the media, etc. Not necessarily working, but considered to work, or or be one of the selective teams, right, behind it. From the tech perspective, unfortunately, there are not too many projects that went farther than Bitcoin. And while some people say, well, Bitcoin is the ancient dinosaur, and the next big thing will pop up, it's not popping up. For whatever reason, it's not popping up. And then we also have to realize that any blockchain project has to. It's not just a website. It's an entire ecosystem. That's what making it so exciting. That's why me personally, for example, I'm not very, very supporting, certain B2B solutions, in the finance space, such as custodian solutions, etc. Because by design, that's not what cryptocurrencies were, created for. By design, it was supposed to be self-custodial, to actually give, power to the people. That was the whole point. If B2B custodians want to do something, then maybe they should create their own coin with a different design, and not try to build, a wrong design on top of the existing proper design, which is wrong from the development perspective points. So when it comes down to from the dev perspective, I'd say that there are not too many projects out there right now that A, have good tech, and B, have any built out ecosystem. The popping projects that are popping based on hype. The hype is mostly created by the giveaways, and the giveaways disappear. The giveaways hype disappears the second giveaways are over. So that's the situation. Yeah.
And Jackson, what's your take on DeFi? Yeah, please.
I can chime in here, because what we do is we assess the market every day. Every morning we look at the entire market as a whole, and we say, what's the narrative here? Right? In our team morning meetings, we say, what's the narrative today? What projects are making the biggest moves, and why they're making those moves? And very clearly, I think everyone can see that DeFi has just making run on run. The reason for that, though, is they solved a very important problem at the beginning, which was allowing borrowers and lenders to meet without a bank.
Mm-hmm.
But when they really started to run was when people started adding funny business to it, which is giving away their own network tokens as a reward to increase the amount of yield you were getting, right? So previously, the problem was, okay, you put your money at a bank, you're getting maybe 0.1% in Australia. It's basically nothing. You put it in a long-term deposit account, you get 1%. In DeFi, when you're lending permissionlessly, you're able to get 5, maybe 10% sometimes. And that was drawing a lot of investors. People saw that and said, well, that's all the investors want. They want annualized yield on their deposits. So what can we do to increase that? So they started making tokens and giving away their project tokens with a pumped up valuation. And that pumped these figures up to like 30, 40, 50, sometimes 1,000% on some days. Obviously, that's not a sustainable thing because the only thing you do with these tokens is you receive them as a reward for staking your assets. Then you sell it. That's the only thing you do. All the participants in these networks are not long-term holders. They're here to acquire the yield. That's the only reason that they've deposited their assets. And they're only going to chase the one that's going to give a higher yield next term. So from a DeFi perspective, the projects that are going to last are the ones that maintain the liquidity long term. They're the infrastructure players, and they're not the players who are giving away their own tokens to subsidize yield. So a really easy way for us to look at it is to say, okay, is the circulating supply a substantial amount of the total supply? If they've already got 90% of their circulating supply out, then they're a pretty good bet. If their circulating supply is 1 or 2%, we pretty much treat that as garbage.
And do you think that participation of large players in DeFi ecosystem kind of goes against, in some ways, like against the principles that are behind it? Because originally it provides opportunity to people who don't have like those large assets to invest. They can also participate in this liquidity, get some kind of reward. But is there something here protecting some people from owning the like most large percent of the market, or how does it work here?
So I think the whole crypto space is permissionless. So like one thing is, if you trade ideologically and you believe that crypto belongs to the people and not the establishments, trading ideologically is a good way to lose your money because the market doesn't care about your ideology. And the unfortunate thing is that there are economies of scale that apply, and in some scenarios, establishments will win out. And the other thing is permissionlessness and being anonymous also makes it easier for the establishments to acquire assets and not be detected. Our view is that this space is an ongoing experiment, and there's no definitive answer for us. But we would like to see a broad access to the population, and we want to see the space develop into a more fair ecosystem. But unfortunately, that's not always the case, and it just really depends on how each network, how each project is designed, and how they build the community to foster more adoption on the user front and less centralization in the hands of early stage VC investors.
Got it. And with my next question, I would like to take a step back a little bit, going back to definitions and see when we're talking about ODC in context with working like with high net worth individuals, what it actually is, because it seems that like there is such limited information in the media, and it's almost impossible to understand what's going on in this space because data is very limited. So maybe Trent, you can tell us, because this is one of the areas where you focus as well, what's going on in this space and how does it relate to your work with family offices and high net worth?
Yeah, definitely. So essentially the reason you'd go to an OTC desk is essentially from a liquidity perspective. If you wanted, high net worths, family offices, emergent wealth institutions are not necessarily going to go to a Binance or a Bittrex and put in an order for 1 million, 10 million, 20 million, 250 million. So that's going to be, I guess, off market, which is one of those things for, I guess, viewers of this panel, is that the price doesn't actually move. So even if there is a large purchase off market, that's not going to move the price of Bitcoin. And so the OTC markets, really stems from having their origins within traditional finance and, let's just say, FX markets. And essentially it's bilateral, counterparty to counterparty. And so essentially, if you really want deep liquidity, then you'll have organizations or companies like ours where if you wanted to purchase like a large block of 1 million, 100,000, 20 million, 10,000, whatever, then you'd be able to do that through our desk. And that's where we're able to really get optimal pricing and have minimal price slippage, because if you were to do it on exchange, that aggregates buyers and sellers, so that if you have, so the price of, if you're buying Bitcoin is going to move substantially if you're purchasing large amounts, because it's going to keep getting executed at the rising prices. And so and I guess that's on the trading part. I mean, I could go talk more into the custody part, but just cognizant of just ensuring that keep to the answering the question.
No, and you just started a very important topic of the risks that large participants of this market can encounter. Like, for example, price slippage is one of them. And this is something that I would like to ask all of you. So what are other risks that we see in this space? What are the risks and how to avoid them?
Maybe I'll answer this one.
Yeah, please.
So from our customers' perspective, the biggest risk to them is a user error, because this space is new and every blockchain is structured differently. They may have assumptions that may not always be correct. There's Bitcoin, there's Ethereum. Most people are quite familiar with ERC20 tokens, but then there are networks that look very similar to ERC20, but they're not actually operating off the same wallets. Then there are cryptocurrencies with addresses that change every time you use it. There's cryptocurrencies with memos. Now, for us, these are quite basic things that everyone's aware of, but for the high net worth investor, they don't care about this stuff. They say, I want to purchase an asset. Usually they have someone else handle the storage for them. They don't spend their time worrying about, okay, does Ripple have a memo or does it not have a memo? And these are the things that are kind of the easiest risks that can be mitigated. On top of that, recently we're seeing on the market side a lot of risk around Ethereum projects, because what's essentially happening is it's now a debt-based ecosystem. Everyone is depositing Ether. They're minting US dollars, in effect, collateralized by the Ethereum price. This is usually measured via Chainlink, and this ties back to the exchanges. If the exchanges have a failure, that introduces risk into the Ethereum ecosystem. If Ethereum has a large price drop, that introduces risk into the ecosystem. Right now, a lot of projects are building on top of each other. So we have lending pools like Aave, Compound, DYDX. We have liquidity mining pools like Balancer, Uniswap, Curve. Each level of, or each layer has one layer of smart contract risk. If you take what's popping off a lot recently, Yearn, or the developers there are building a product where the assets are jumping across like 4 or 5 smart contracts constantly, and any level, at any layer, a bug could basically catastrophically destroy the access to the assets in the ecosystem.
Yeah.
It's growing really rapidly. So that's a really big risk that we're seeing currently. But yeah, there's plenty more, but they're all very different risks that the traditional investors would not be aware of.
Got it. And Peter, in your perspective, what are the main risks and how you're helping to solve this risk?
I would say the main risk is liquidity still. There's lots of advertised liquidity. This liquidity is not necessarily accurate. There are a bunch of pools available to, the more, not high net worth individuals, but more to the funds, more to the bigger players. But when it comes down to retailers and even high net worth individuals, the liquidity is really a big issue. Even when we are talking about, Bitcoin, the liquidity is, transferred through bid-ask spreads, through high trading fees, through, all kinds of exchange errors, right, that are taking place. Now, the other kind of like to answer one of the questions that was asked before, in my opinion, the main mistake that most investors are making in this space is they are going after capital gains, and capital gains are absolute. Like it's an absolute possibility. Crypto, well, Bitcoin itself has been up anywhere from 50 to 100% per year over the last 8 years. So it's very, very good. With enough liquidity if you invest $1,000. So therefore, all the other assets, such as Ether and Litecoin and DeFi projects and small caps, all this stuff, all this stuff is also moving potentially even higher. But what those investors don't realize is that it's not about the capital gains that will give them the most profit. It is building out the ecosystem for 1 or 5 or 10 or whatever the projects they really go after through either investing their resources of money, time, connections, maybe development talent if they're developers themselves, or maybe some human capital. So I think that's the biggest kind of we'll translate it into the biggest risk of most investors are here for the capital gains, and that's a huge error, because this whole blockchain ecosystem allows you to really build up an asset you're part of, and therefore if you build it properly, the price will follow naturally. So you won't have to gamble and try to watch the charts at 4 a.m. in the morning trying to trade the Korean market. So that's I think that the two risks are liquidity and then risk of just going for the capital gains as opposed to building the ecosystem.
I think I pretty much outlined the main risks, and it seems that one of them. Please, yeah.
I guess one of the risks and barriers would be the regulatory frameworks, depending on the jurisdiction you're in, and having an understanding of that, because that has been one of the barriers to having really meaningful investment in the space. One of the other risks would be the infrastructure, and behind that, the custody. And so now that there is, certainly numerous insured custodians out there at the moment that are providing digital asset insurance, but also really secure institutional custody as well. So, but if we're looking at the infrastructure of how a person self-custodies, and ensuring that their own, so I'm talking about an infrastructure from a user's perspective. Now, moving on from the service provider's perspective, but also the education, ensuring that the right education. One of the risks is that we're in the, I guess we have the paradox of choice because of the sheer amount of information, education available online, and there's also a risk, I think, as well of indecision, because Bitcoin and digital assets are one of those things that people are curious about, and they can see it, but when it's too low, they're worried about it. Then it goes up, then it becomes too expensive, and so they find themselves in this range of indecision. And so there's a risk of not investing in. There's a risk of investing in. Now, if we look at the two side by side of not investing in, then it's potentially missing out on a digitally native asset class which has been built for this digital age, but also have an asymmetric risk profile and return profile, so that a very small investment, so let's just say Paul Tudor Jones invested 1-2% of his net worth in it, that 1-2% could be one of his most meaningful investments on the upside, but on the downside, if it all goes to crap, goes to zero, then he's only really lost 1-2%. And so it's one of those risks, particularly now, in being comfortable with the traditional thesis or investment thesis, because if we look at how the markets are correlated and continuing to swim in those markets, which are being propped up by government or Federal Reserve money printing that are going in to purchase securities and bonds, then it's almost like we have this sort of false economy. And so you can be lured into this false economy that there is safety here, because it's much more easier to trust and believe and have confidence in something that has been around for a long time versus something that may just have come on the radar of these particular investors in the last few years. And so I think the more information that gets out there is great, but there's a risk that it could be misleading, because just like any space, you'll have good and bad information. But the risks around whether to invest or not is really dependent for new investors on the information, the education that's available. So there are just a few of the other risks, and I'm sure that there's some more, but they're ones that I would probably highlight.
It's very interesting with custody, because right now I think self-custody is being promoted as the safest way. Although if you lose your keys, you lose all your crypto. But it seems that in the case with the bigger players, when you have more at stake and you're risking of losing, for example, millions of dollars with your private key, it becomes a lot more relevant than we're seeing it just on retail market. So yeah, it's a very interesting aspect of that. That still goes back to the human factor. And to get into some specifics, what do you think, who are...
Can I just make a comment on that? Because it always makes me laugh. Obama said back in 2016 at South by Southwest, I think it was, that, Bitcoin or digital assets is like walking around with a Swiss bank account in your pocket. And it's more like a Swiss bank, because you're the teller, the CEO. And you can cross a border with $1 billion of liquidity. And I mean, it's out of the purview of the relevant tax authorities and government authorities. And so it really is one of those, from a custody perspective, it sounds great, right? Ideologically. But what we find is that not everyone wants to be their own bank. And so as much as that narrative has been propped up about being your own bank, it's great, but it's scary, for first-time users, and even if you've been experienced users, of transferring significant amounts, ensuring that you do a Satoshi test or what have you. And so what we find with high net worth and institutional investors is that they're not wanting to necessarily take on that accountability, because there is, and so that really puts a fiduciary duty on the relevant service providers as well, and custodians. But yeah, it's an interesting narrative, the whole, you are your own bank, or be your own bank, but it's not necessarily what a lot of people want. So
it's a very good point. What do you think, what other narratives are you seeing in this space? And this is a question for everyone. And what narratives do you think are not correct? Something that's being promoted that people think that this is exactly what their clients want. but this is not what they want, just like with the case of Be Your Own Bank. Are there any other similar narratives that you're seeing? Or maybe misunderstanding or some cliches that you have seen that are proved not right completely?
I just spoke before, so I'll give someone else the microphone, or the proverbial microphone.
Yeah, we can talk about kind of crypto as an asset for the community, because that's kind of what brought a lot of us into the space. Is we are thinking, okay, there's a lot of financial inequality, and crypto as an asset class was built to bring up the bottom half and even the playing field. A interesting series of events around SushiSwap recently. If anyone's unaware, there was a product that was built off of copying and then tweaking Uniswap's open source code, and the developer was anonymous, and he had invented a mechanism to migrate the liquidity from Uniswap to SushiSwap, which ultimately makes the new product actually achieve better prices for the end consumer. But the problem with it was that the developer was anonymous, and he had decided that 1 week after building out the project, he was going to exit and sell all of his holdings. The community was understandably really angry with him, and he was, from a public perception perspective, voted out of the project, and controls were given to, well, basically he had passed over access to another member, and then the Twitter community got to vote on who are the holders of these admin keys for the multi-sig. And what we saw was that the votes, because they're it's one token, one vote, not one person, one vote. It's not a democracy. It's kind of a maybe a plutocracy, a benevolent one, maybe. But what you'll see is that all the established players work for companies, and they have capital behind them. They have their own capital. They have their clients' capital, and they can deploy those funds as votes. And we saw that ultimately the community, the participants, the candidates who would describe themselves as community members, were usually individuals. They didn't have a company behind them, but they were really active in the community. And we saw them get downvoted with sushi tokens, and the company's employees were vastly upvoted. So you see that every time a founder steps out in DeFi, it can very quickly become cannibalized by the institutions with the most money. So, for me, this is still playing out as an experiment, and yeah, we're always curiously watching to see how this all plays out.
It's very interesting. And it kind of sounds, and by the way, like I see a bunch of comments, but no questions. So I just keep going with what I have lined up, because there are many things that I'm personally curious about the space. And what we kind of went through, I see a bunch of messages for both people representing family offices and high net worth individuals. But if we talk about the companies who are servicing them, what would you advise? So what should these companies be having in mind? Maybe Peter, would you like to answer this one?
So this question and the previous question, the continuation, and pretty much the same answer. I disagree with the fact lots of people want mass adoption because they want to be Mark Zuckerbergs, want to get $20 billion for themselves, build nothing useful for the majority of us, and just be happy and pretty much sustain this wealth for their loved ones, until their grandkids fuck things up. That's what most people want, unfortunately, in the space. Now, is this the right approach? Like, oh, people don't want to be their own bank. Oh, people don't want to take additional effort, and how about we just improve the UX to such a point where they just paid money, and if they pay their precious $10, the product has to be so freaking good that they don't have to do anything and they get exactly what they want. I don't think that's what crypto is for. Not because I'm like super ideological, etc. The point is this, right? Finally, we have this tool to actually change something, to actually change the regulatory environment, to actually change the legal system. It's not going to be on the macro level. Yes, there's going to be some small communities globally. Who cares? It is a possibility that it is a vehicle, because blockchain allows us to create ecosystem with its own economic system, with its own voting system, with its own governance. And we either take this opportunity and do something with this by educating everybody who wants to be educated, and therefore build this tiny community. And even if we get 1% of everybody in the world, that's 70 million people, right? That's like a small country. That can do a lot of things. I mean, that can govern itself and can provide lots of resources, and therefore can actually have some kind of say and some kind of control. But when the S&P 500 is down because 1% or whatever, 1.5%, because Feds decide to yet execute another dump in the S&P 500, buy cheap, and then announce that, oh, now money will be printed again, and print another $7 trillion, and thus somehow drive this inflation, and then pass that inflation on to Europe, and then Europe will pass it on to the emerging countries, and then emerging countries will we'll pass it on to some other countries. And at the end of the day, everybody will struggle. And I have no say in this, and I do not know what's going to happen if I had a mortgage. I don't know what to think. I don't. But I don't know what am I going to do? I don't know how much I have to suck up to my boss just so he doesn't fire me, because if he fires me, I'm screwed completely, because I'm all mortgaged out. I'm all credited. I don't think this is just a good system to live in, where I have I cannot pretty much decide anything. So I don't think we should be going after UX. Yes, UX is important, but we should really go after education. Building a really nice viral app that brings nothing to the table is not the easiest thing, but it's pretty easy. Obviously, it's not super easy, but it's pretty easy relative to building the entire ecosystem from scratch, educating everybody, and actually creating an army of followers, an actual army of followers with its own resources, who are willing to go until the end, right? Creating those 300 Spartans who can, beat up the central banking system. Or we can just create an app and say, hey, now it's easy. Now crypto is for everybody. Come here, we'll milk you, because you can create a really good UX and people will still not know what to do with it. They'll still lose their money. You just help them to lose their money. Great. So I'm more at the forefront of, let's not use people. Let's actually use this amazing, technology of blockchain to educate everybody and create this army of followers. That was a very long answer to a short question. Sorry.
No, but it's interesting. Do you think that, like in the case of high net worth individuals, the principle is the same as with the retail investors? Because, for example, we haven't touched upon regulation, but it's a big topic that I hope to touch upon in part 2. What I'm hearing, for example, from KYC space, that often these players, they don't want to be going through the process themselves. They want to send a bunch of documents and have someone just fill it in for them. So it's not even as important to have a nice UX, because they are not willing to do this in the first place. So like how different it is for retail players in mass adoption and the adoption on the institutional level among players as family offices.
From a
what you just said.
From a KYC perspective, it's quite simple for an individual to KYC, because you upload your identity document, you scan your face, and you're pretty much good to go. for high net worth individuals, the vast majority of the time, they're not investing as a personal account. They're investing as a family trust, they're investing as a company or a superannuation fund. And there's a lot more documentation that needs to get verified. And for every country, those set of documents are different. So that's why the kind of UX doesn't matter so much for them. And because of the high complexity, they're kind of just like, I don't really want to deal with figuring out forms for what. I'm just going to dump a whole lot of scanned documents to you on an email. You figure out what you need, email me back if there's anything missing, and I'll go get them. That's kind of what we're seeing.
That's what was my thinking around it as well. Just talking through, because we have about 10 minutes left, and I would like to get into something that you're seeing specifically on the market that helps, like, one, tackle these risks that we just discussed, and then help with education, better educating the broader audience and this specific type of clients. Who specifically do you think is contributing to the space best? What are you excited about in the space? Trent?
Yeah. Can I actually touch on just one of the narratives, which is probably a narrative that is forming, because I think just some insights from that, from where we sit, would be, I think, really beneficial. And then can come back to that question if that's okay.
Sure.
So essentially, one of the really interesting demographics that we've sort of come across, or that we are really interested in exploring further, is that whole emergent wealth. Because if you really look at, for instance, traditional investments like property, where it was own your own home, get yourself into debt with the bank. And if you look at the property globally in a lot of the cities, so I mean, Jackson and I are in Melbourne. Melbourne and Sydney in Australia rank in the top 15, top 20 most expensive cities in the world. Shanghai, Hong Kong, Singapore from Asia are up there in like the top 5 or 10. So you're looking at you're seeing the rise of the emergent wealth, which we would classify in Australia as someone that has 50,000 of liquid capital to invest or to allocate, that aren't necessarily looking for a home to get into debt to. Because we look at the emergent wealth and sort of what matters to them, it's very much built around experience, purpose, and liquidity. Being able to experience the world, travel, purpose. We know that we definitely see a rise, particularly in the last decade, of purpose-driven investments, where you have investing in making the world a better place, environmental sustainability, helping, let's say, bank the unbanked, or microfinance in Africa, but also liquidity, so that they can move in and out of experiences, investments, seamlessly. So we actually see this narrative forming that, particularly in the digital asset space, where high net worth individuals from this emergent wealth class can quickly become a high net worth like that, because of if we look at the definition of liquid wealth of $1 million, there's plenty of stories around out there, particularly in the DeFi space, for instance, with the meteoric rise of compound yearn or yearn in the DeFi space. But even if you're looking at other assets, digital assets that are going up for 4x, 10x, and so the emergent wealth can really become this high net worth in a very short amount of time. And they're not necessarily going to be on a private banking client list, or a list that you can go to access. They're not necessarily even going to be reporting that. So there's this like hidden high net worth and ultra high net worth. And I think 2017, early 2018 bull run really created a lot of liquid high net worths that which created a whole bunch of different issues. How do you get that money back into the traditional financial system? And how well does each individual want to fit in with the regulatory frameworks of the jurisdiction they're in? So I think properties become super expensive, living conditions. Looking at stocks, the emergent wealth class, they're typically driven towards like technology stocks that they would interact with on a day-to-day basis. VC investments, and with Peter, and don't have a great understanding, but artificial intelligence, emergent technology, there's a big drive towards that from what we're seeing in digital assets, not just stores of wealth, but also NFTs, the DeFi space, because the emergent wealth demographic for us, they tend to have a higher risk tolerance than older, Gen X like myself, baby boomers. And they're also looking to invest in impact. And I guess one of the catch cries of 2017, 2018 was bank the unbanked. And I remember seeing this Twitter post from Vitalik when we hit, I think it was 500 billion. And everyone's going, yeah, we did it, 500 billion. And he's like, yeah, but how many unbanked have we banked? It's just there tends to be a lot of virtual signaling in the space, but I think there are a lot of great projects that are coming up that are particularly around, let's say, microfinance, and particularly as we move from we transition into a cashless world, based on a lot of the cash bans, the removal of denominations of cash globally, how that's going to affect the emerging economies, different emergent wealth that I've been talking about. But anyway, I'm conscious of the time. I can talk on that for all day, but I think we don't have much longer. And so yeah,
that's what we'll need the second edition for, but we will announce it a little later. Jackson, some final things you would like to say to wrap it up? Projects you're excited about, or maybe just the trends that you're seeing in this space?
So I throughout this panel, I've been pretty critical of DeFi, but I think DeFi is actually the biggest contributor to the crypto space. They are innovating extremely rapidly, and they're bringing solutions into the crypto space that no one else is touching on. So really, when the only way this reaches the public is if we achieve liquidity, if we achieve a much larger market cap than 300 billion. And that's just going to come with time. That's just going to come with innovation and good products being built in the space. Watching the DeFi space is extremely important. I think it's extraordinarily high risk right now because everything that's pumping is pretty much the first iteration of it, and it just all needs to get proven with time. But over time, as an industry, decentralized finance, I believe, is going to be the killer app of crypto.
Thank you. And Peter, how do you see the trends of digital assets specifically for high net worth and family offices, and what's your prediction for this space in general? Final words of today's panel.
Let me just say final words of today's panel, because the other question is too difficult. Everybody should start realizing that you should invest, and the top investors already know that. Warren Buffett, right? Charlie Munger, George Soros. You have to invest only where you have control. So if you want to invest into a blockchain space, into this specific cryptocurrency, into this specific DeFi project, you better have some level of control. You better know where those people live, the CEOs. You better know how they're collecting the money, what the money is going to be spent, and not just what they are bullshitting you, but actually what is actually going to happen. If a project is raising $80 million, maybe, and it's a team of 5 people, I mean, maybe something is wrong. Maybe you should actually become, a COO, a legal COO of this organization as an investor in order to actually make some kind of decision. So when investing in projects, do not focus on capital gains. Focus on the capital gains alone will typically not result in capital gains. They typically result in losses. So if you focus on actually building the ecosystem for this specific project, or just for a group of projects, or for the overall industry, crypto industry, that's going to be, everybody's going to be much better off, yourself included. the industry itself, and what's it called, and the project. So who is doing this right now? Let's shout out to the Blockchain Center. The Blockchain Center is in the education. The more and more people I meet from the Blockchain Center, the more and more I'm personally impressed with the quality of what they're doing specifically to nurture the space. So yeah, that's it for me. Final words.
Got it. Okay, I think that's it for today then. Thank you so much, everyone, for joining us. We'll be continuing on this topic next week, Thursday, same time. We will announce it separately. Yeah, and thank you so much for being with us. And we will see you next time here at Blockchain Center.